We're also keeping close tabs on inflation. Inflation slowed for the 10th straight month in April, climbing 4.9% year over year, but still held firmly above the Fed's 2% annual target. Joining us now, we've got Lakshman Achuthan, who is the Economic Cycle Research Institute co-founder, and Paul Gruenwald, who is the S&P Global Economist. Great to have you both here with us today. You see a print like this morning come out. You're the Fed. You're digesting this data. What does this signal for even the course of conversation at the next meeting where you need to make a decision?
Yeah, well, the numbers were a little bit better, right? So the Fed's focusing more on core than the headline, but the core is still 5.5. And then late last week, we got the PCE core, which they also follow, which is about 4.5. So I guess directionally, we're going the correct way, which is lower, but we're still well above target. And we know the labor market's still very hot, right? Unemployment dipped down to 3.4 last week. So the pause is kind of conditional or data dependent, if you will, on how things are going to play out. But, we're kind of winning little battles, but we haven't won the war yet on inflation. I think we got to wait to see if we can get down to 2.
Yeah, it feels like we're in the percolation period, right? Where the Fed's raise, and now we kind of wait for it to make its way through a little bit more, right?
Sure. It's like, you're a kid in the car and you're like, are we there yet?
Yes.
And it doesn't happen that fast. Yes, we're in a cyclical downturn in inflation. That's the good news in a sense. But it's a little sticky on the way down. It's not a straight line down. And the core services, the wage inflation, these are real concerns for the Fed. So as you were saying, with unemployment at 3.4%, that's like a 54-something year record low. That's not giving them a break. That's not giving the Fed a green light to pause or cut. And so here, I don't think it really gives them any quarter to ease. And there's also a separate, I just want to clarify something. There's the pace of inflation, right? And then there's the level of prices. And so Wall Street, we're all into the pace of inflation. Hey, we can see it's decelerating. Okay. Main Street, people out there are all looking at the level of inflation. And if you think about something like a car, used car prices, they're about 50% higher than pre-COVID. That's a big step up. And people feel that.
And our wages are not 50% higher?
Not quite. They're higher.
We got some real wage negative numbers this morning as well, which is also part of the calculus, right? Because inflation is high, and this kind of disproportionately hits the more vulnerable parts of the population, which is why we need to get inflation down, and there's still a way to go. But totally agree on the point. The level of prices, the rate of change of the prices may be slowing, but the level's still quite high, and this is taking away purchasing power.
And depending upon income level within the population, you could already be experiencing perhaps, and by the time we get to a real recession as defined, you could already have been in a recession for quite some time. So what does that do on a much kind of longer term outlook for an economic recovery across income levels as well?
Yeah, well, fuddy-duddies like me think that inflation needs to get back down to 2, because I agree with the point that it's probably easier to let inflation go to 3-ish and then settle there. But that's not really a dynamically consistent story, because the next time we get a bout of inflation, you might say, well, maybe 4 is good enough. And then you go down this slippery slope. And if we think that high inflation and prices hurt the most vulnerable, which I think is empirically true, then we want to kind of, tough it out and get back down to 2. But, we're laying the foundation to get the economy on a more sustainable path. And, that's a path where, unemployment's kind of low to mid 4s, inflation's 2 is kind of our golden path. But we ain't there yet. We're trying to land softly to that path.
Well, yeah, and I totally agree with you. And it's totally disconnected from what the market wants, right? So the market is looking for a pause or a cut. And that is just not in the cards. If you're going towards 2%, right, which is linked to the Fed's credibility, then in cyclical terms, if you look at cycles in growth and cycles in inflation, you have to acknowledge that these low points in inflation, when it cycles down, only occur after the recession is over. And we're talking about, did it start yet?
Right.
Okay, so just to give you again this time, this idea of time, and are we there yet? It's going to take a little while. We're not there yet.
Yeah, Julie, that's your percolation challenge, right? When we were behind the curve, it was easy to raise rates aggressively, but now we're at the point where, we're probably close to where we want to be in terms of the peak of the cycle. We know that monetary policy works with a lag, and we know things are going to be slowing down Then it gets a little bit trickier, right? Because you're trying to be, a little bit tough on rates to make sure financial conditions are appropriate to get your inflation down to 2. But because of these lags, we're going to see the progress after the slowdown, and that's where the communication gets really tricky for central banks. Fed, ECB, a lot of central banks are in that bucket right now.
Yeah. So are we? So what you guys are saying, it sort of leaves the door open that are we actually? Is the Fed actually done? I mean, in other words, yes, we'll give some time to see how these changes work their way through the economy. There's a lot of folks who are sort of waving their hands in the air and saying things are terrible right now and that things are dire and that the Fed needs to cut already and that,
these are both true. But they're both, it's both true, right? Which there are things that are terrible. Real retail sales are down 5 months in a row. You don't see that outside of a recession. There's other things that
housing market, some are saying is in a recession.
Starting to peak out. There's credit problems where you're starting to see that contraction. We're seeing all of these things that are totally consistent with a harder rather than softer landing. So yes, that's true. And the Fed, having missed the boat earlier, in order to maintain its credibility, has to get this inflation under control and really going down. And there's always something there that they say. But I think he said last time he was talking, Powell was talking. I need to see a couple of months of these numbers really in a more comfortable place. And today's not that day.
Right.
Yeah, I was going to say I agree with that. The market pricing is still. When I checked yesterday, we had a couple of cuts priced in by the end of this year. The market wants to go there, but the Fed's watching inflation, and again, because they and other central banks missed the boat. A lot of us economists missed the boat last year. They still have a 2% target, and they don't want to miss it on the high side and have to start hiking aggressively again. So I think they're going both ways. I'm not sure today's data point really tips it either way, so we'll have to see how it plays out next couple of months. I think that's right.
We had got some data from the New York Fed as well, saying that inflation expectations, they're falling at short-term horizon, but rising slightly at longer horizons as well. What does that signal for how the Fed might still have some hiking to do later on should inflation rear its head again?
Well, it definitely supports a higher for longer, right? What you're really concerned about, if from a central banker point of view, is longer-term inflation expectations inching up a bit. So if you look at the 70s, and we were all very young then, if you were even alive, right? You have these. No, if you were even alive, right? So you have these cycles in inflation, and what's interesting is when they're tightening and inflation's coming down, tons of pressure, political pressure, all this stuff to stop tightening. And the bottoms in the inflation cycle get higher and higher. And that's what they don't want to repeat.
Right. And to that point, if your medium-term inflation expectations are well anchored at your target, which is 2, which means the market and the population thinks you're going to deliver on your mandate, that actually makes your work a bit easier, right? They got partially de-anchored last year, which means, as we like to say, everything else constant, the Fed and other central banks are going to have to do a little bit more in order to bring inflation down and re-anchor those.
Yep.
The market, though, doesn't believe it. Right? I mean, I don't know. It keeps changing, right? Yeah. I'm looking at December probability right now from the Fed Watch, the CME Fed Watch, and 4.25 to 4.5 is where most of the bets are clustered right now. That implies a cut. 46.3% probability right now. Now, this keeps changing, to be fair, but is it just wishful thinking on the part of the market that the Fed's going to cut before year end?
I'll go quickly because I want to let you speak. Yeah. This particular cycle, if you kind of track that since when did the Fed lift off? March of 2022. The market has been underestimating the Fed every move this cycle. So they've got this psyche, it used to be called the Greenspan put or the Fed put or the whatever put. They think that the Fed's it's fill in the blank put, that the Fed is going to, sort of cave and cut rates when things get a bit dicey. They raised in March in the middle of the Silicon Valley Bank sort of, turbulence, and they raised again this past week. So maybe again, we're going to see that the market's underestimating the fortitude of the Fed this cycle.
Or, I'll take the other side, because I agree with what you're saying. So it was a long time ago we said, look, the Fed's going to keep doing this until either they're getting hit in the face with a recession or something breaks. The market may be betting in a weird way, something's going to break. Because when you take all of the business models that are out there that are predicated on really low interest rates and rapidly change that cost of capital, stuff starts to falter.
Although to Paul's point, something did break.
Well,
and the Fed still kept going.
Let's wait.
Okay, so something terrible is going to happen. Is what the market's banking on.
The other way to put that in is if you're telling me the Fed's going to be cutting 3 times by the end of the year and sitting at 4 2/4, 4.5. I'm asking what your macro forecast is. You don't have the unemployment rate at 3.4, and you don't have all this inflation pressure. So they've got a recession in there.
Things are going to get bad. Hopefully not. All right, guys, thanks so much. We got to leave it there. Really great discussion. Lakshman, Achuthan, Economic Cycle Research Institute co-founder, and Paul Gruenwald, S&P Global Economist. Thanks to you both. Really appreciate it.